Thanks very much. Yeah, the Federal Reserve minutes are out from the recent meeting. They're saying the coronavirus caused tremendous human and economic hardship in the U.S. and around the world. They're concerned the virus will weigh heavily on economic activity. All of that we knew, but they did discuss some additional measures they could take. The committee could provide more explicit forward guidance at future meetings. That's been an issue that's been discussed. It could be either date-based or it could be outcome-based. In other words, based upon GDP hitting a certain level or a certain amount of time for how low interest rates would be. They could also provide additional detail on Treasury and mortgage-backed security purchases or plans to buy, and they did discuss doing additional quantitative easing. Finally, and this is a bit of the bombshell, but just be careful because they didn't decide on this, they did discuss capping rates at specified levels, capping rates in the short and medium-term markets at specified levels for a certain amount of time. It's been something that's been out there as to whether or not the Fed might discuss this, either targeting the yield curve or actually targeting rates. If Rick hasn't fallen down, you may want to ask him about this. He might be on the floor right now, but that is something that they've discussed in terms of additional potential tools they could have. But again, not decided, guys. So I'm going to go back in and read some more of this unless you have some questions. But you can see clearly the Fed discussing the things it had in place at the time, the plans to implement those, and then what further it can do. And this really meshes with what Powell has been saying about his thinking about the need to plan for doing more than doing less, and even going beyond what's already been out there and proposed. Tyler?
Steve, let me ask you a question. Capping rates, what does that mean in practice, and what would that mean to the bond market or the equity markets?
Well, you'd have to ask somebody a little bit older than I am. I think it was the 1950s that there was an interest rate cap. I'm going to search that word and find that section again in the okay, so I'm going to read you directly what it says here. A few participants, no, it's a few, it's not the majority of the committee, also noted that the balance sheet could be used to reinforce the committee's forward guidance regarding the path of the funds rate through purchases of Treasury securities on a scale necessary, here's the part, to keep Treasury yields at short to medium-term maturities capped at specified levels for a period of time. I guess the Fed would say the interest rate on the 2-year shall be 1.5%, or I guess it'd be much lower than that, 0.5% or 0.2%, I guess where it is now. And we will buy and sell securities such that we would keep that there. Now, the thing about the Fed is they often don't have to actually do anything. They can set things to a certain cap, and the market kind of magically adjusts there. But that's the way it would do it. It would, I guess, conduct open market operations around a specific maturity or maturities that would keep the rate at a certain place. And this would allow it to have more of an impact on the economy. For example, targeting the 5-year is a place where a lot of business loans are targeted off of, so they could keep that rate down if they needed to.